Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm glad to have with me once again a guest who has probably now made about as many appearances on this show as anyone. I'm talking about Michael Oliver, whose technical work I have been watching closely for the last couple of years, and it's a work that I have gained increasing confidence in over time. And it's easy to say get in, get out, but Michael is watching day by day what's going on in key markets, and I think does a very good job of keeping his readers posted on where things are at any given time. We don't want to get out too early in a bull market, but we don't want to wait too long either. So, Michael, thanks for joining me again.
Good to be here, Jay.
Always good to talk to you. You know, would like to focus on the equity markets first, perhaps. And Dr. Robert McHugh is another technical analyst that I pay some attention to. And let me just read to you, Michael, what he wrote, then I want to get your comments on it. He says, and I quote, "Stocks are working very hard to finish the last rising leg of the rising bearish wedge that started in October 2014. We have to be patient while this terminal market fights for each breath. This is what we would expect as stocks put in a major top. There is less and less participation in the rally. Smart money is distributing shares to weak hands. The market has lost a ton of upside momentum, as evidenced by the difference between average new highs and new lows shrinking as prices approach this top. The NYSE cumulative advanced decline line has diverged bearishly versus stock prices, and an official Hindenburg omen is on the clock. Many of our key indicators have lengthening bearish divergences with stocks. A multi-decade megaphone top pattern is essentially complete. All signs of a coming top and the start of a major bear market. This quiet period will lead to panic selling, we believe, before the end of 2015. So the question to you, Michael, is, I know you don't use the same technical tools that Robert McHugh uses. You may use some of them or look at some of them from time to time. You have your own unique proprietary technology, which is what I think makes you very valuable. But what would you, any comments on McHugh's views of the equity market?
He and I should have a beer together because we're in total agreement. I have respect for him. He's an Elliott wave theorist, and I think he's a good one for that mode of discipline. He analyzes price, of course, and I analyze price secondarily. I look at momentum of price first and foremost, long-term, intermediate, and short-term, and so forth, and in various markets. And I see... I try not to have vibes or feelings. Mm-hmm. I've been around in the market since '75, so it's easy to have feelings. And I'm not a good person to ask, what do you feel? I'm probably as amateur as anybody. But over time, I think I've matured and inculcated my own technical work, and to where it is so heavy right now in terms of its gravity, in terms of what it's implying, that I think he's probably right. I think we're really close. I'm not sure whether you're going to make new highs in the S&P. We made highs 2 months ago when we've not exceeded them. And by the way, those highs were where early in the year I thought the high should be, around 2130, give or take 1%. So far we've not exceeded that high, and we're trying our damnedest to do it, but it's very slow. He's right. We're very narrow. In fact, you can circle a BTK index or the ETFs of the biotech sector. That's your leadership. It is not technology. There's no sector out there that's burning up the charts. Technology's been flat versus the S&P for a year. In fact, you can look at some of the technology ETFs like XLK, for example, and you'll see we're toying with prices we were at a year ago. So there's no explosion there. It's biotech only. And it's a speculative fever. I mean, there's good fundamentals behind it in terms of future expectations, not necessarily present realities. But it's very much akin to what the Internet.com bubble did in 2000. Many people preached about what great things would come from the Internet, and they were, if anything, understating the reality that ultimately came from the Internet. Mm-hmm. But the problem was that the Internet sector priced itself off the page. And so it dropped 89 cents on the dollar before it was over with. Mm-hmm. Biotech is effectively in the same condition now, and I'm looking for the turning point there. And I think if you can time a biotech downturn, you could probably time the equity market downturn, because I think the leadership is literally that narrow at this point.
That certainly is in line with what McHugh was saying, for sure. Yeah,
I think so.
Yeah. Go ahead. You had another thought?
Well, the bond markets are the interesting part right now because obviously they're huge. They're bigger than the equity markets.
Sure.
And it's the market that everybody thinks, well, if the CBs or central banks are in control of events, which has been the assumption for at least 3 years, if not longer, it's now the point of it being a religion, and you can't buck the Fed or the ECB or the Bank of Japan. Well, the bond markets just did, and they did it big time. And it's not because the central banks allowed it to happen. It happened in their face. Yeah. The ECBs have been buying French oats and Italian bonds and so forth for months now, since January, their new QE, and those markets doubled their interest rates in a matter of weeks. In fact, our 30-year bond, 30-year Treasury, went from 2.2% yield to 3.2 in a heartbeat. A lot of people look at the long-term yield charts on that market and draw their trend lines and so forth. In fact, in a recent MSA report, I included that chart along with the momentum chart. And all I can add to that issue is we've reached 3.2%, a recent high, and again today on the 30-year. You get up to about 3.72% and much above there, and you're breaking out over a 30-year downtrend line in terms of annual momentum of the bond. And a bit above there in yield, around 4%, or 3.95 to be more precise, you're breaking out on the price charts of the yield charts going back 30 years. So we've already covered 2/3 of the turf needed to achieve a major breakout, indicating a rising yield. So there's not a lot more room here. And I have a suspicion that these government debt markets have it in for the equity markets. In other words, they're not going to stop their slide in price and rise in yield until they spark a response, a temper tantrum, out of the equity markets. And that's kind of where I think you'll get your first bond market rally, is once the bonds and T-notes and so forth have encouraged fear in the equity markets. Oh. And we obviously haven't reached that point yet. I think it'll be a rapid tipping point event when it happens.
Yeah. You had an interesting article titled Judas Goat. Can you talk to us about what you meant, Judas Goat?
That's the debt markets. Yeah, they're leading the equities to the slaughter. And I think that this, I sent out a report today, and by the way, my site is olivermsa.com.
Thank you.
But on the T-note market, the T-note futures, that's a 10-year debt market, which is comparable to the 10-year bonds in Germany and so forth. The action there, even on a price chart of the 10-year notes going back 8 years, is challenging a major price chart trend line. In fact, it's below it right now. You don't want to close the month, and there's only, 5 trading days left in the 10-year note futures around where you are now, because it indicates a whole new leg of decline, rise in yield about to begin, that's the kind of event that I think that if you move that one tectonic plate, namely the debt markets, which again the public thinks is the most under the control of the CBs, if you can demonstrate they're not, then all faith goes out the window, and then who's going to support the equity markets if they couldn't hold their own bond markets together?
Oh, my goodness,
and I think that's what gold's waiting on as well. I know there's a lot of frustrated gold bulls out there who think that at any moment we're going to open the bottom up and go drop down to $1,000 or something. It's always possible. But I think gold is doing exactly what stocks have been doing for the last number of months, and that is just sit here. Torture people on both sides of the equation. If I were a gold bear right now and I shorted gold a year and a half, 2 years ago at 1180, I'm at the same price today.
Yeah, interesting.
I'm not making money either, so you got to look at it that way. Anyway, I think the bond markets are our first important tectonic plate to move, and the other two we're watching very carefully, week by week, month by month, are the equity indexes and the precious metals markets.
You made some observations about resource stocks in your weekly letter that came out this weekend. Specifically, you looked at base metals and precious metals mining stocks. Would you care to share your views of the two sectors within the mining community?
Well, yeah, absolutely. The commodities as a whole, including the base metals and the precious metals and grains and sugar and so forth, basically all peaked in their recovery from the 2008 lows. They peaked in 2011. And they declined fairly seriously. Oil joined in late, just last summer and fall. It was a laggard to the group. But this collapse has occurred, and therefore the performance of such stocks as BHP, Billiton, and Rio Tinto, and so forth, the iron stocks, has been pathetic versus the S&P. Not only have they underperformed the market, they've actually gone down in price. The same has been true with gold mining stocks. So you can lump them all together as metals miners. But in fact, if you do a little more subtle investigation, you'll see that, one, the spread difference between the base metal miners and the S&P, while it continues down, that's not the case with the gold miners. They've stabilized. In fact, most gold miners stopped dropping last November. Whereas if you go back and look at BHP and so forth, where it was last November, or look at, Freeport-McMoRan.
Freeport-McMoRan, you're right.
Copper and gold, but copper primarily. Where it was last November, it's sharply below there. Huh. But the gold stocks have not joined in that last 6 months of decline. And I think that's important. I think it's a hint that while the economy of the world remains negative, as evidenced by the base metals and their miners, the performance of those markets, it is not remaining negative for the gold miners, such that you can have inflation and a weak economy at the same time, is sort of the hint there. I'm still harking back to the 1976-77 period, where that same phenomenon occurred. We had a weak domestic and global economy, and yet we had resurgence of inflation that enjoyed the last 3 or 4 years of the 70s. The commodity markets led by gold, whereas equities did nothing during that time. It wasn't until the 80s that the equity market could finally get its motor going. The commodities took all the liquidity that was provided by the central banks then and ran with it. And I'm seeing the evidence of that now in the issue of the deflation, which everybody's fearful of. Robert Prechter, for example, it's his theme right now is much more deflation. I can see some more in some commodity markets, oil, base metals, and so forth. I don't see a lot more. I think they've largely shot their whatever they're going to do, they've done it. And I think a lot of commodities are on the edge of turning up now. I would say the grains, sugar, for example, the agricultural markets look poised to turn up, whereas some markets still look like there's more downside. It's a mixed picture, but it's stabilizing. So I don't buy into the argument of this ongoing collapse in prices. I think if there's a collapse in prices to come, it's in the one that hasn't collapsed, namely the equity markets.
Yeah, and the debt markets, of course.
In the debt markets, yes.
The granddaddy of them all. Let me ask you, with respect to gold, you put out some key numbers for gold and silver. You usually look at it like month to month, right? So if we get into July, what are sort of your target numbers for gold, and if you have one for silver as well?
I get very specific in the market reports to subscribers, but in general, I'll say this. This applies both to gold, silver on one side, and equities on the other, non-gold equities, S&P and so forth. About 3% above the current market, silver and gold next month. If you close the month there, I would be very excited if I'm a bull. I would be very excited. I think that we're headed up. It's only 3%, no big deal. In the equity markets, I think you got a 1% tolerance. I think if you find yourself about 1% below where you're trading right now, either closing this month out, so you open next month there, or trade there next month, you're in trouble. And so now I've seen enough movement in the debt markets to be convinced that plate has moved. And I'm still looking for these other two to shift their balance. And they're both within, single-digit percents of doing much in terms of changing the major trend, down in equities, up in gold. And it one good day, at the right time, you're there. So.
Yeah, well, for sure. That's absolutely right. We have a couple of minutes left yet. I want to go back to the bond issue, the Bund. You mentioned, I think in one of your recent missives, you talked about the German Bund being very near a critical level. And the Bund, of course, was the one that moved earlier than the Treasuries, the German debt, sovereign debt instrument. Where does that stand today? I don't know if I haven't had a chance to look at it myself.
First off, the peak was around 162 on the Bund futures. And this is the equivalent to the U.S. 10-year note in Germany. And this is the, quote, most stable debt instrument in Europe. I mean, it's not France, it's not Italy, it's Germany, okay? Yep. Yet it went from 162 and dropped into the 148s. Did it in a matter of a few months. Started in April and recently. Now, we're in the 150 right now, around 150 today. So we're not at the low, but we're close. I think you go about 3 points below that low that we made a few weeks ago, and a whole new can of worms opens up. So what it's trying to do is hang in here at a level that it can try to post a rally. but the pressure is still on. And if you look at the UST notes, they went back to their low today.
Yeah.
Meaning the high yields that they've seen. So same with the 30-year U.S. So the pressure is still on, and I'm not at all sure that we've seen the near-term low in these markets in terms of price or high-end yields. Mm-hmm. And if it doesn't stop here, that may be the window where I put out a report today at, again, OliverMSA.com called Tantrum. And I showed that T-note chart, and if that T-note chart doesn't stop where it is now, I think you're in that window where the debt markets just a little bit more, you create a total water churns to ice type phenomenon in stocks, chemical change. Stocks have been ignoring the rise in yields. Yeah. As if, well, it doesn't matter. The CBs are still in control. That's the assumption.
Right. Yeah.
Well,
yeah. As long as people believe that.
Of anything.
Yeah. As long as people believe that. I mean, that's the key, isn't it? It's all about confidence. And when that confidence is shattered, then you're going to see some real fast movements in those plate tectonics.
That is the tactical fundamental of our time. That's the tactical fundamental. You can talk about anything else, earnings and all, et cetera, et cetera. The tactical fundamental is the belief structure in central banks control asset prices. Yeah. And if you discover they don't, you have to change everything.
Well, I think using a geological term, I think we may be looking at a gigantic subduction zone occurring when that day happens. And I'm not cheering for it, believe me, Michael, but
I'll have to title a report after that.
What's that?
I'll have to title a report that, the subduction zone.
Yeah, a gigantic subduction zone. You come up with some very colorful titles for your charts, like Tantrum, you said. I'm looking forward to reading that one. I haven't yet. But I would tell my listeners it's OliverMSA.com. Oliver, M as in Mary, S as in Sam, A as in Albert, OliverMSA.com. Go there, folks. This guy has really got a lot of, I think, very timely and important information to pass along to you. That's why he's on this show almost every week. Whenever I have a chance, I get Michael on. Thank you so much, Michael, for being with me once again, and all the best.
Thank you again, Jay. Bye-bye.